Hello and welcome to Amberger Smackdown. I'm J. Christoph Amberger, and I'd like to take the opportunity to announce that I have formed an exploratory committee to determine beyond the shadow of a doubt that I shouldn't run for president. Having overgrazed on Britney Spears' new hairdo, or lack thereof, and on American Idol contestants, the migrant herd of professional and amateur pundits has shifted gears. It's serious now. The real estate crash, mortgage lenders collapse, subprime loan defaults. It's time to burn your house and collect from the crooked insurance man, writes a hard-bitten blogger. He recommends to make sure it looked like an accident. The multitasking wannabe arsonist finds a backup singer in a friendly finger-pointer who has figured out who's behind the real estate crunch. President Bush and his policies, of course. In the days of the real estate boom, his neighborhood apparently had been overrun by hordes of young Republicans, pressing zero-down adjustable rate mortgages on indigents. Far more professional, a popular financial editor wishes we were done with the plunging property prices and promises the worst property-led recession of the last 76 years, a coming mega-bust, a tidal wave of hurt. Don't be afraid, he has a financial survivor kit he'd like to send you immediately with your permission. And the news sounds grim indeed. The Mortgage Bankers Association reported that more than 2.1 million Americans with a home loan missed at least one payment in the final quarter of 2006. Nationwide, 14% of subprime and adjustable rate mortgages were past due. 0.54% of homeowners with a mortgage began foreclosure proceedings, up from 0.46% in the third quarter. And the rate of new foreclosures hit a record. Based on the numbers, the American stock indices resumed the downs and downs again we had seen earlier in March. But with so many chicken littles running amok in the courtyard, I think it may be time for a bit of perspective. Delinquencies and late payments numbers may reflect new records, but so do all of the other numbers. American home ownership is at record levels as well. And while 14% of subprime borrowers may be late on their payments, that means 86% of subprime borrowers are paying their vinyl-sided mansions off on time. Here's my question to you. Are you actually surprised that people who have bad credit can't pay their loans back on time? After all, not being able to pay their bills on time was the reason they have bad credit in the first place. By accepting the contorted credit constructs offered to them by venturesome lenders, whose risk calculation models had been structured to account for the inherent uncertainty, these bad risks took advantage of undeserved credit. And guess what? That's what happens if you make the decision to live beyond your means. It's exactly what happens to a business that bases its niche on insufficient risk assessment and on intentionally ignoring the realities of its market and client base. Of course, not all mortgage delinquencies are the result of living large. When you look at the percentage of all delinquent loans by state, two states stand out: Mississippi with 10.6% delinquent loans and Louisiana with 9.1%. The third worst state, Michigan, comes in with 7.9%. From here we see a gradual decrease in delinquency rates. The substantial difference between Mississippi and Louisiana and those other states is not a reflection of financial irresponsibility, but the late fallout of Hurricane Katrina. Many displaced inhabitants still are paying down mortgages on destroyed homes while rebuilding and paying rent somewhere else. The shakeout of subprime lenders is the market purging a risky business model that has outlived the narrowly defined parameters of its existence. And unlike the two previous real estate crises we have witnessed and lived through since Jimmy Carter took office, the overall economic environment seems robust enough to cope with the fallout. Unemployment is at 4.5%, not at 13% plus like in the Carter era. Interest rates are under 6% and not 18% plus. GDP growth is plugging along very fine, thank you very much, and inflation tightly contained despite the high energy prices. Incomes have been growing faster than inflation despite the dip in residential construction activity, and family net worth is at an all-time high. The current shakeout of mortgage lender stocks is not quite over yet. It will affect lenders whose risk management is far better than that of New Century, like our favorite dividend workhorse, Impact Mortgage Holdings. But overall, the story of plunging real estate values that my colleague wants to scare us with is just not true. In fact, as the snow is melting and we wash the inch-thick layer of salt off our cars, house sales have been picking up all over the East Coast. American demographics argue in favor of a sustained demand for real estate for years to come. Every year, the United States adds a new population segment the size of Chicago, and the echo boom generation is beginning to push into college. Real estate is and should remain a cornerstone of your net worth, even if you have to leverage it with debt. People with short attention spans tend to forget that extended bull markets have occasional setbacks and corrections. But people with short attention spans rarely make much money either. For TaipanFinancialNews.com, I'm J. Christoph Amberger, wishing you a memorable week.